I'm actually going to go ahead and explain a little bit more about the rest of the conference. It's just going to be this panel, and then immediately thereafter, with no break, we're going to have Professor Michael McConnell, who, as director of the Constitutional Law Center, is the co-sponsor of this conference, and he will provide closing remarks and a wrap-up. And then immediately thereafter, there is a reception in the faculty lounge, this time open to everyone. So we look forward to seeing you all there. That will be immediately after Professor McConnell's remarks. So for now, I want to introduce beloved friend and a great financial theorist, Anat Admati, professor of financial economics at the Graduate School of Business here at Stanford. For her panel, The Economic Causes and Consequences of State Debt. And I'll let her introduce her panelists.
Thank you, Peter. Thank you for inviting me. This is a sort of different kind of panel, and the only moderator without a formal law degree. So
stop bragging.
Infiltrating this institution, as I've been trying to do for a while. Secret dreams of being be here. So this panel, I guess, has only one law faculty. And otherwise, it has probably more economics and finance than law, so it would be a little different that way. And it's also kind of the most eclectic group, so will be kind of all over the place. And one thing that was certainly, we're just going to go by the order that we said, if that's okay. It was completely random from my perspective. But I'll enforce the time. So, and one thing that has been in the background all day, I mentioned a few times explicitly, and now is going to be on the table for at least 10 minutes straight, is possibly one of the biggest liabilities of the states. And lurking in the background of every discussion of this topic is the pension funds. So we have the eminent, best expert on this subject, coming from Wharton, and that is Olivia Mitchell. And so, Olivia.
Thanks. If you don't mind, I think I'll go up here just to,
sure.
I did bring PowerPoints, not knowing that was not done in legal profession. Actually, many people did do it here, so I have an excuse. So it's great to be with you today, and I'm delighted. Thank you very much, Peter, for inviting me, and Anat for moderating us. I think we'll be easy to moderate. My task was at first described to me as talking a little bit about the history of U.S. public pensions to give us some perspective on how we got where we are. And so let me do that by saying a few words about the history of U.S. pensions. It goes back actually to the period when we were a colony. During the colonial period, the UK had disability pensions for the militia that was operating here in the territories. During the Revolution, interestingly enough, the Continental Congress set up an Army-Navy disability plan. Actually, they were two separate plans at the time. And then the federal government later converted them to veterans' pensions. And that's not atypical. Many countries around the world will have military pensions before anything else in order to try to provide some incentive to join the military and then to leave when the time arises. The U.S. cities provided pensions to teachers, firemen, police officers, and so forth in the mid-19th century. So these go back a very long way. And they're part and parcel of the conversion of the patronage system to a merit system of civil servants in the United States. The 1935 Social Security Act was very important in the development of state and local pensions because, at least initially, the U.S. Social Security Act covered private sector corporate employees and excluded public sector individuals. Thereafter, in 1950, Social Security did start to allow public sector coverage. Governmental units at that time could decide if they wanted to enter or withdraw from Social Security. Now, what that led to was by the early 1960s, most states having their own retirement plans for their own civil servants, teachers, judges, lawyers, firefighters, police, etc., except for the 3 or 4 listed there. Now, this continued up till the early 1980s, at which point, as you may remember, the great Greenspan Commission of 1983, this was put in place to help fix Social Security, which was 3 months from running out of benefit money to pay checks to grandma. And at that time, the right of states and localities to pull out of Social Security was eliminated. So today, 7 states back from those times still are not included in Social Security, and you can see them listed here. Alaska, Colorado, Louisiana, Maine, Massachusetts, Nevada, and Ohio. And some local governments are also not included in Social Security, depending on the jurisdiction. And this is one reason it's very difficult for people to try to do an apples-to-apples comparison of state and local government wages and benefits. In some cases, they're not even covered by Social Security. In other cases, they are. Obviously, if they're not, then the expectation would be that the public sector employer would raise the benefits somewhat to offset the lack of Social Security benefits. It's important to know that about 1 in 4 public sector employees today is not included in Social Security. And so again, this is a relatively big portion of the folks that we're thinking about. And it also has consequences. If those public pensions were not paid, they don't have Social Security to rely on. And so that's something to keep in mind. Now, I'm probably preaching to the choir here, but there's a lot of misunderstanding, especially in the rest of the world, about the 2 types of pensions. And this is just a very quick distinction between defined benefit plans, which is what most state and local government employees have. And here's what's going on in this type of plan. The benefit is promised, or more specifically, a benefit formula. So they'll say it'll be 1.5% or 2% of your final pay multiplied by your years of service. If it's a 2% plan times 40 years of service, you'll get 80% of your final pay as your benefit, usually paid as an annuity until you die. The converse is what many academics are familiar with, the defined contribution 401k, 403b model, where instead of telling you what the benefit is, they tell you what the contribution is, you invest it, and you get what you get, including nothing if you happen to have invested your entire defined contribution at Enron. And there are a few hybrid plans we can talk about if you wish. The big controversy in pension land is funding the pension. That is, setting aside sufficient assets to pay for the promised future benefits. There's lots of positives to funding, pre-funding the benefits. That is, you can reduce uncertainty about whether you're really going to get paid, you can diversify and so forth. There's some cons, some negatives, as we frequently hear in the discussion around Social Security reform, and increasingly in the state and local arena. If you're going to pay up to cover that underfunding bit, then somebody's going to have to pay twice. That is, you're going to have to pay for the legacy costs, which weren't properly financed and pre-funded, and going forward, you're going to have to set aside money to do that as well. I just like this graph, this figure. This is the pay-as-you-go approach to paying for pensions. The taxes and contributions go in the pipe at the left, and they're immediately or pretty near immediately paid out at the right. Conversely, this is the slightly more sophisticated picture that goes with the defined benefit plan. You have the contributions going in for the employee and the employer on the left. You have investment earnings building up in the fund, and that's the top right-hand pipe with a little dial on it. Those are the investment earnings. As the money's built up, it can then be paid out to retirees. That's the bottom right-hand spigot. And the tiny, we hope, tiny little faucet down at the lower left that's not labeled is what? Fees and commissions, okay? So then the question is, why are defined benefit plans so frequently underfunded? How do the states and localities get into this position? Obviously, many of them in the U.S. have some assets, and those are resulting from the contributions, both employer and employee, as well as the investment earnings. And then on the other side of the ledger, you have the liabilities. And this is where there's a lot of controversy about the pension issue. The liabilities represent nothing more than the discounted expected present value of all the benefits that are owed to current workers and retirees already in place. There's some controversy about whether future accruals are also counted. Many states and localities do as well. But the fundamental issue is that in order to compute the discounted present value of those liabilities, You have to add up the Bs. Those are the benefits you owe to retirees today, next year, next year, next year. You have to discount them to the present. And note the very crucial role of the R, the interest rate or the discount rate in this formula. Basically what you're doing, if you take on a defined benefit obligation, you're promising to pay retirees now and until the last one dies, which may well be 100 years from now. And particularly if you have joint and survivor, it gets to be a very, very long obligation. So I've used 90 here in this formula, but the point is it's a big number. Anytime the interest rate goes down, so notice where it falls in the equation. The interest rate is going down, the liabilities go up. And they're extraordinarily sensitive to even a apparently very small change in the interest rate. And this is actually what we've been facing currently. The interest rates have gone down, leading to the plans being substantially underfunded, the liabilities increasing substantially. So obviously, if the employer goes bankrupt, if there's insufficient assets in the plans, then retirees may get no benefits or may have them reduced, and that's what we're kind of worried about. So I like this one from the New York Times. On the left, we have Uncle Sam, the federal government, saying, oh, you really don't notice it after a while, and you have the states and the municipalities sitting under a pretty large block of unfunded pension liabilities as well. How do we get into this situation? Part of it was the market crash. The state pension plans were holding 70, sometimes higher fractions of their assets in equities, and they didn't pay much attention to the mismatch between the assets in the plans and the liabilities in the plans. Discount rates, I've just mentioned. There's lots of other stuff going on, too. People aren't paying attention. Taxpayers are not. I think the actives and the retirees have been uninformed, somewhat intentionally, I would argue, because there's virtually no transparency on the state and local pension liabilities, assets, or underfunding. The politicians have inevitably short time horizons. They're happy to make an agreement between the union and the state employees to keep things quiet today and kick the can down the road so that 50 years from now, somebody else will have to pay those benefits. And the result has been states have not contributed what they're supposed to have contributed. The plans have discounted the liabilities too heavily. The assets were too heavily invested in equity, and some will simply not be able to pay. Now, the claim was made earlier today that, oh, well, state debt is not really that big and pensions are not that big. This is somewhat in the eye of the beholder. Here we have Hawaii that has 16.2% of GDP. Let me put it this way, that the pension debt plus the explicit debt is about 16.2% of GDP. Mississippi, you see Connecticut, West Virginia, Massachusetts. These are not small numbers. And so we have to start worrying about the state's ability to pay, not just for their explicit debt, but for the implicit debt as well. As will be described in greater detail by my colleague, the underfunding situation is actually much worse than what you read about in the press. The reason is that the reported liabilities, which are the first column, and you see Ohio, Colorado, and Illinois listed in terms of billions, are too low by virtue of the fact that the states persistently use over-optimistic discount rates. If you do it more credibly, the unfunded liabilities double, triple in some cases. If you were to try to pay them, not that I would suggest you would, but if you were to try to fund up the unfunded liabilities, that would be 600% of state tax revenue in a given year. And the list goes on, and there's others in this paper by my colleague Josh Rao and Novi Marks. So let me just finish. Oh, I have 1 minute left. Good. So if you added up all the numbers, you get a number something like $3 trillion at Treasury rates. It's a big number. It's certainly on par, maybe even exceeding current explicit tax state debt amounts that are noted. What can we do? Many states are changing the rules. They're raising contributions. They're delaying retirement and so forth. As we've heard today, there's a lot of question about what we can do in terms of constitutional guarantees. Many states, and particularly many from the right wing, are saying what we should just do is replace the existing program with a defined contribution plan. Of course, there tend to be some who would object to that. But my point is really very simple. Replacing the existing plan with a defined contribution plan does not get rid of any of the unfunded liabilities from the past. You still have to cope with those. So let me leave you, economists are always very depressing, so here's the humorous moment. The little boy is talking to his sister, he's just broken apart his piggy bank, and he says, now we just have to sit back and wait for the Fed to bail us out. So let me stop there, and we'll take questions during the Q&A. Thanks.
No. We haven't been doing that, Joe.
So, Professor Mitchell, thank you very much. Professor Mitchell's presentation is entirely consistent with my presentation. Couldn't be a better introduction. Basically, I'm going to explain that, number one, we're screwed, right? Quite probably. There's the conclusion. I'd like to give you 7 reasons, all right? And I will over-intellectualize the reasons why we're screwed. First, the problem is complicated. Second, the problem is very long dated. We're talking, as Professor Mitchell pointed out, situations where you've got to discount liabilities of potentially 90 years in the future. Politely stated, the problem is arcane. All right, it requires really deep understanding both of accounting, finance, and throw in the law. Fourth, it requires mathematics more complicated than long division. All right, I will typically lose many of my students whenever I get to, they can handle 4 divided by 2, but 7 divided by 3, I begin losing them. All right, and here we're doing much more than 7 divided by 3. As Professor Mitchell has pointed out, the time horizon here is much longer than the relevant political cycles. It's entirely rational for every politician to kick this can down the road as far as possible. It's also an environment in which we have fundamental incentive incompatibilities, meaning that we don't really have arm's length bargaining. We have a tremendous amount of institutional capture. Many of the politicians have incentives to curry favor with voters, and the voters are the beneficiaries of many of these plans. That's not a prescription for the tightest negotiating behavior on both sides of the table. And last, and the point that I'm going to focus on, is stupid accounting tricks. And we've seen stupid accounting tricks get this country into trouble when we start looking at what recently happened in our financial crisis. It will do the same in this area. Now, to try to make the situation as simple as possible, when we ask the question of, are we underwater and by how much are we underwater, we can go through myriad accounting and financial conventions and techniques. Many of the papers that Professor Mitchell has cited to use a wide variety of techniques. But at the end of the day, there's one simple question as to which you'd want the answer, and that is, if you were going to find a third party who was willing to take over all of the state obligations, pension obligations, healthcare obligations and the like, would this third party pay you for the right to do that? Say, I will take the current amount in the fund and whatever flow we expect to get, and I think I'll make money on that, so I will pay you for the right to take over your position. Or would you have to pay somebody to get rid of the position? Here you would almost certainly have to pay somebody to take over the California obligations, the Louisiana obligations, the Illinois obligations. And the question then really is, how much would you have to pay this fella or this gal to take over that position? So the math, if you think about it, is a way that we pointy-headed academics are trying to triangulate how much it is the states would have to pay a hypothetical third party to come in and take over that position. Okay? Now, the accounting-based technique that is used to generate the estimates of the liabilities here can politely be described as perverse. Okay? And before going to a story about value at risk and how value at risk accounting got us into trouble in the great financial crisis, well, let me start with that, because you manage what you can measure, and if you're measuring something incorrectly, you're going to manage it incorrectly. And value at risk was a form of risk measurement and control whereby a bank or a financial institution would have a look at its portfolio, and it would statistically calculate what is the maximum amount we can lose overnight, for example, with a 1% probability, or over a 1-month period with a 1% probability, a variety of different metrics. And people would then manage to that result, and if you were being incentivized according to your returns, conditional on any value at risk, you would look at two portfolio managers within the bank, and what you would say is, if one gets a higher rate of return with the same value at risk, then he's a better portfolio manager. The trouble with that is, you can standardize your value at risk by simply taking riskier bets. Because if what I do is if I lengthen the tail of my distribution and in effect write out of the money options, I don't increase my 1% VAR because I'm keeping that fixed. I'm just making the tail longer and fatter farther out there. I'm increasing my rate of return, so there's a hidden incentive, all right, to actually take riskier positions because you're compensated for that because we're measuring the wrong thing the wrong way. We're doing the same thing over here in a very interesting way. The accounting rule basically says you discount your future liabilities as a function of your expected rate of return on the assets. Well, how stupid is that? What that means is the higher rate of return I expect on my assets, the lower the present discounted value of my liabilities. Am I right about this, Professor?
Absolutely.
There you go, all right? Now, a little demonstration about how nuts-making this is. If instead what I do is, instead of having a conservatively managed portfolio, I go to a risky portfolio, which has an expected rate of return of 12% or 15%, I can dramatically reduce the size of my liabilities, all right? But because the formula does not take into account the additional risk that I have to take in order to generate the 12 to 15%, I can actually do very stupid things, and if I'm stupid enough, I can actually get rid of my pension deficit and declare a surplus that I can then distribute to my state employees or state. So let me give you a specific example of this. I was going to work it up, and I found that these two guys that you pointed out have already done this example. They figured it out too. Under current accounting standards, state governments could ostensibly meet their obligations using futures contracts on the stock market to maintain a leverage ratio of 10 to 1. In other words, we're going to do a leveraged stock market bet of 10 to 1. The expected annual return is roughly 90%, all right? So you would then be required under accounting rules to discount your obligations at a 90% discount rate. So state pension funds, oh, this is going to wind up in your column. You're going to love this. It's good. So state pension funds would only need to invest about $750 million today to have a mean asset value of $9.45 trillion in 50 years' time. This strategy would free up $1.94 trillion, essentially all assets currently sitting in public pension funds. So after paying off all pension fund obligations, all right, along with the entire $1 trillion in state bonds, the states could distribute $1 trillion, or more than $3,500 for each of the 280 million American women and children, all while maintaining a fully funded pension system under current accounting rules. Okay? So, if you believe that the current accounting rules are right, all right, well, why don't you really embrace them? Why don't we lever up on equities 10 to 1, all right? Go all in on Vegas, all right? We take the expected return. We totally ignore the risk that's generated by this strategy because the accounting rules say we pay no attention to the risk. We look only at the expected returns. That way, when we discount at that rate, which of course is the big mistake in this calculation, we make all of our future obligations disappear, and we can declare a dividend. All right? Now, the problem with talking about this out loud is that some politicians will actually think this is a good idea. And for 4 years, it's a great idea, right? I paid you money, and we're terrific. So the question is, how do you do this? What's the right way to think about it? The approach that I think that comes closest to some picture of reality is to use something along the lines of a Monte Carlo simulation approach. None of us know what the future is going to bring. It's impossible to know with certainty. One of the many problems in this area is we're using point estimates. We're totally losing all information about the probability distributions inherent on the liabilities that we have and inherent on the potential income streams that we might get. And again, these two guys, Novi Marks and Josh Rao, figured that out too. God bless them, they're doing it the right way. They did a real simple Monte Carlo analysis and using a range of assumptions which are, and I think, perfectly reasonable. The 50% probability, in other words, what Vegas would call the over-under, all right, where you would set the line if you were a bookie in Vegas, is that we've got, just for the obligations that we have now, and not taking into account the other pension benefits, we are anywhere between 2.8 and 3.92 trillion in the hole, all right? Which, and if you view all current state debt as being about $1 trillion, all right, this pension obligation is between 2.8 to 4 times as large as. Now, typically, as economists, we look at the 5% confidence intervals. At the 5% interval on the downside, the situation could be as bad as 4 to 4.66 trillion. And at the 5% confidence interval to the upside, assuming that we have the 5% best case, we're only 830 billion to 2.69 trillion, all right? The probability that there is a profit, that this actually works under current funding, is less than 1%, and you have to make the most optimistic of all assumptions. It's not impossible, it's just I wouldn't bet on it.
Felix Salmon from Reuters.
Yeah, what he said. Yeah, no, he's absolutely right, and I have major problems with Monte Carlo simulations for many reasons, but they're certainly better than point estimates, and you know, you can do anything with discount rates, and actually one of the problems that we're dealing with here is that what we're doing is, no matter how many probability distributions we manipulate and come back to, you're always trying to come back to, you know, one of these numbers. It's 2 trillion, it's 3 trillion, it's 4 trillion, and we're getting. I'm not entirely clear how helpful these numbers are, especially since we're comparing them to real sort of bonded debt, which is coming due every few months and needs to get paid out in coupons and principals, and that's very different than this sort of. I mean, it's no more real, but it's very different qualitatively from this sort of fuzzy obligation to pensioners in many decades' time, when we don't even really know what those pensions are going to look like. We do know they're not going to look exactly like they're written right now, for various reasons. I just wanted to get a little bit out of the realm of theory and into the realm of markets, just because no one's really been talking about markets today, and the municipal bond markets in particular, because at the beginning of the day, people was showing us charts, so CDS spreads and bond spreads, and with the implication there that this is the way that the market, this is a sort of price discovery mechanism, and that you can look at these spreads and say, well, that's the, you know, you punch in some kind of assumed recovery rate, and then you can get a default probability. And so if Illinois is trading at however many basis points over treasuries, and that means it has this percentage probability of default. And this kind of reasoning, I think, is very dangerous, and it's erroneous. And there's a few points which I want to make. The first one Anat actually already made, which is that if you want to look at who comes out well and who comes out badly in any kind of situation where a government or state entity can't cover all of its liabilities, then you just basically need to look at who the creditors are, who is being owed money. And this is a point which actually Warren Buffett has made a few times. Every so often he toys in public with the idea of setting up a bond insurer and then decides not to. And his point is that the people who own municipal debt are the richest and most powerful people in any state. Individuals. Like, they're the friends of the politicians. They're the people that the politicians have dinner with. They have lots of money because they have, this liquid disposable savings to invest in muni bonds. And these people are very, very hard to default on. And in fact, I think we can say with a pretty high degree of certainty that they won't be defaulted on. And this is my one big theory here, is that people are talking about bankruptcy and people are talking about default, and what I put to you is that you will possibly, conceivably, find a state which gets into so much trouble that it will default on its bonded obligations, but there will not be a haircut. What will happen is it will just go into arrears and something will happen, and then those bondholders will get paid back in full without having to wait too long to see the money, because those people are powerful. And in fact, a lot of them will get paid back immediately because there's a sort of moral hazard issue here that the states where a lot of the general obligation bonds are insured by a monoline, they'll just be like, and Anna will remember this very well, like when the first Ecuador defaulted while saying, it's not really a default because you'll still get your money because there's this rolling interest guarantee, so don't worry about it, you'll get your coupon payment. And I can definitely see situations where states are going to sort of default and say, don't worry about it, it's insured by NBIA, you'll get your coupon payment. So those kind of things will happen, but the creditors are powerful, they will get their money, and yet at the same time, for the first time ever, they're worried that they won't. And the fact is that most of these people, for their entire investing career, have been investing in municipal bonds because they are basically rate instruments which are tax-free. There's no credit analysis going on there whatsoever. And they wake up one morning and suddenly these are credit instruments. There's credit risk, there's market risk. They see, you can look at the price of California or Illinois bonds on the market and see, you own these bonds, they went down in value substantially, you lost money. And it never occurred to these people that you might be able to invest in municipal bonds and lose money. So even if you are 100% certainly going to get paid in full at the end of the day, you're looking at your portfolio, you're looking at your brokerage statements, the value of your bonds has gone down, you're getting worried. These are clearly not risk-free instruments anymore. You thought they were, you were wrong. And so you're not buying them anymore. And when you stop buying them anymore, that is the bid in the market, right? We can talk about, Clay was talking a bit about the difference between individual investors and mutual funds. They're basically the same. You can either buy bonds directly or you can buy them through a mutual fund. But basically, we're talking about individual taxpayers in these states who are accounting for the vast majority of the tax-free municipal debt out there. And that bid has disappeared. And the federal government stepped in to fill that hole with the Build America Bond program, which was a very good program, and it's very sad that it's gone away. But that's come to an end now, and it's not coming back. And so there's a real liquidity problem here. The states are having a big, big problem of where are they going to fund themselves, because the people who used to give them money are now saying, well, this is not something I'm interested in anymore because there's risk there. And I was never, historically these were risk-free assets and they attracted very, very risk-averse investors. And so now the states need to start on a whole new process of finding investors with a bit more of a risk appetite who are going to maybe require a higher yield who are going to need a bit more hand-holding and education process, but you're going to have to start talking to them about, constitutionality issues and stuff like that. It's going to be much more difficult. You're going to have to pay them more money. And yields are just going to take a sort of big step up. But that big step up in yields is not indicative of a significant increase in credit risk. You don't look at that increase in yields and say, oh, well, that means that there's an implied probability of default of 15% over the next 5 years, and this kind of thing. You're looking at the markets in the wrong way if you're doing that. So that's my main point. Let's not be extrapolating too much. Like if you're looking at Greece, I think it's entirely reasonable to look at those yields and see a lot of credit risk in there. But when you're looking at California and you're looking at Illinois, I think what you're seeing is mostly market risk and the fact that there's just this big problem in terms of the investor base. The investor base is going to have to change from your grandmother to someone who's a little bit more sophisticated, and that hasn't happened yet, and it will take a long time. And for the foreseeable future, this is going to be a big problem for municipal finances and this is actually, and we've been talking all day about the solvency problem facing the states, but actually, I think the bigger problem is a liquidity problem, because they don't know how to fill that gap.
Okay, well, thank you very much. So people can start thinking about their questions. I just want to get started a little bit. Talking. So, of course, Joe, it's crazy hocus pocus that you can do if you start playing around with the discount rates. One question I have, as somebody who teaches about the yield curve, is why one rate? What rate? One rate should it be, or would it be?
Yeah, the Novi Marks and Rao papers actually take the whole yield curve and do
Right.
yield matching, and they
But it's only
do the
30
math
years
much
that we
more
have, but
sensibly.
it's only 30 years that we have of a curve, but.
Right, and we're talking about liabilities that go out a much longer period of time. But that, in a certain sense, is about the easiest of the issues. I mean, there's so many other problems that, as a theoretical and empirical matter,
Sure.
are much
You have
more
uncertainty
profound.
about life
It's-
expectancy and.
Yeah,
all kinds of things.
it's the fact, it's this clearly demonstrable fiction that the only thing we care about are the expected returns.
Sure.
And then, once we make the mistake of only looking at the expected returns, ignoring all the risk, we then look at the expected return of the wrong thing. All right? I mean, the mistakes couldn't be more pervasive or more profound.
Yeah, I mean, there's interest rate and, of course, whatever instrument you have, risk.
Right.
So, you want to kind of match, duration match, if you were going
Professor,
to.
I don't know what your view on this
Olivia, you
is.
can call me Olivia.
Olivia.
If I could just jump in briefly,
go ahead.
I would say it's even worse than what you say. In other
was gonna
words,
say it's
you're
worse than what you say.
soft-pedaling it. Because
We have a competition for how
Because
bad
to
it
my
is.
mind, there's absolutely no earthly reason that the discount rate on pension obligations, which by the way are guaranteed in most cases by state constitutions, should have any resemblance whatsoever to the expected returns on the assets in the plan. Now, the point is that the pension promises are going to be delivered by the state to the police, the firefighters, the teachers, and whatever. And the worst you should do, probably, the highest rate you should use, is whatever the cost the state faces of borrowing money. Right? Maybe not totally risk-free, but much lower than 8, 12%. Whatever they think they could make on assets should have theoretically no conceptual relation. So that's one problem. The other problem is the assets are funky too. So the assets are typically smoothed. Many of them are not market value. Many of them are constructed. Many of the assets, increasingly, I think New Jersey is in the position right now of trying to move its cap on alternatives to 38%. So you don't even really know what the value is for many of these alternatives. And so the fact is that this expected return is even a bigger fiction for the assets much aside from whether you should use them for the liabilities. And I think, yes, it's arcane, it's mathematics, and it's finance and so forth, but at the end of the day, if taxpayers don't know, if residents of the states don't know, if the union leaders don't know, and most of them claim not to, and I think they probably don't, if the bond raters aren't paying attention, then we have a huge problem of transparency.
No, I think we do, and to me, what's really remarkable is the more I've looked at this, if you set out to try to come up with an accounting rule that was most divergent from economic reality, it would be hard to do better than what the accounting profession in this area has actually done. I mean, typically you would think you want the accounting rules to reflect economic reality. You look at what happens here, and you sort of, you must wonder institutionally. I don't know the history of the evolution of these rules, but there's got to be some underlying political or institutional vector that drives such a tremendous gap that between economic reality and what you report on the books. And the deficits reported on the books are already substantial, and that's under a very favorable and entirely irrational form of accounting.
So all day long, we were saying that bankruptcy is not an option, and that, there's balanced budget rules everywhere. Well, what does that all mean? Is the question. What's going to happen? It said consequences is part of our panel title.
So, I mean, there are adjustments underway, right? And for better, for worse for some people. Some states like Wisconsin have gotten rid of the cost of living index for the pensions post-retirement, and they've instead keyed them to some sort of rate of return in the market. Many states are trying to raise the retirement ages. They're increasing the vesting period. They're making employees contribute more, and et cetera. Right? So there's lots and lots of efforts.
All of which, by the way, is one reason why pension obligations are not the same as bonded debt, because you can fiddle around with them in the way that you can't fiddle around with bonds.
But to my mind, and I'm a pension junkie, not necessarily a bankruptcy junkie, it seems to me the big problem for consumers, households, retirees, taxpayers, is the uncertainty of this all. When you're 20 years old or 30 and starting to think about saving for retirement, you want to have some notion of what the future will be like so that you can make your saving, your investment, and your retirement plans accordingly. With this current system we have, it's piecemeal, it's arbitrary, who gets cut under what circumstances, who has to pay more under certain circumstances, makes the whole thing almost laughable. You cannot plan accordingly.
And your point is incredibly well taken, that you have an enormous number of retirees in places like Vallejo who aren't covered by Social Security. Mm-hmm. And Vallejo goes bust, and they're absolutely screwed. And there's no conceivable reason why does a firefighter in Vallejo get screwed, whereas the firefighter in the city next door doesn't. It just is not fair on any level, and the way the government has become sort of fragmented and balkanized in this way just makes no sense from a sort of political economy point of view at all.
Olivia, can you just make a quick comment about whether there is a move towards defined contribution, sort of following the private sector, or are they going to go these other routes?
Well, two comments. Many states have moved toward defined contribution plans. Some states have actually already terminated the access to new entrants, and they all have into the old defined benefit plans, and they all have to go into defined contribution plans. The issue, though, is that as long as you're guaranteeing all current actives and past retirees continued payouts from the defined benefit plan, it's going to take 60 years before you get any really alleviation of the contribution needs for the existing plans. The other thing that I will say is that defined contribution plans do impose more risk on participants, right? On the other hand, they're much more beneficial. You have portability, you have the option to diversify your investments. Potentially, participants become somewhat more financially literate in the process of having to think about what
In
they're doing.
reality, they get roughly 3 percentage points lower annual returns.
Which is too bad.
Than
Not
the
efficient.
returns on defined benefit plans, because you invest badly as an individual, you
Small
have
scale.
lots of fees, you get ripped off by your brokers. Like your actual returns are much lower in DC plans.
Well, but if you take into account bankruptcy of states and private sector employers, then you have to factor that in. The other point I will make, and this is a general point about defined benefit plans, probably 6 times a week I'll get somebody calling me and saying, oh, the golden age of defined benefit plans, regretfully, we've left it, never to return. And my answer is yes, those were good for a period of time for some people. Only 1 out of 10 employees that ever started working in a defined benefit plan ever got a final benefit. Because if you quit, if you changed jobs, if you went home, it wasn't portable, you didn't get anything. So we have to take into account the pros and cons of both.
Investment periods and the like. And the other point, you're absolutely right, and I won't go on about this, but there are ways to solve that problem, all right? And I've got a financial interest in a company that solves
near
that
the
problem.
mic.
And financial engines. So there are ways that you can do investments in the 401k defined contribution space where you don't underperform. But it's a minority of companies who do that.
Okay, we'll start with,
Well, this is a question about the private sector. To what extent are there must be accounting requirements for defined benefit plans run by private corporations? Although I don't know where they come from, but there must be some requirements. Are they any good? Do they represent in any respect a model that could be applied to the public sector? Is anyone working on reforming them? If the answer is no to the last question.
Well, so as you may know, ERISA, which is the 1974 Employee Retirement Income Security Act, passed a number of rules for corporate pension plans, that is, non-public pension plans. And then subsequently, and there was a lot of other legislation, but in 2006, the Pension Protection Act amended and changed some of the accounting rules. But in corporate pension land, you must fund your unfunded liabilities. It used to be over 30 years, now it's 7 for most of the private sector. You must use the corporate yield curve, and furthermore, you must pay into a pension, a government-sponsored pension organization known as the PBGC that charges premiums to try to cover the eventuality that the corporate sponsor will go broke. We can talk, the PBGC parenthetically is not fully funded either, so it's not a very good answer to the problem, but there are
premiums
national
in any
rules.
way based on the risk associated with
There are national
funding
rules, and the
insured?
PPA tried to put in place not only premiums based on the degree of underfunding, but the risk of the parent employer, the company as well. And furthermore, if you get to retirement age or even along the way and you want to take a lump sum out of the pension in the corporate sector, they won't let you if the plan is very underfunded. So there's efforts to try to restrict those. The FASB, which is the Financial Accounting Standards Board that governs the private pensions, has tried to move that down the road. By contrast, GASB, which is the Government Accounting Standards Board, it's the government equivalent of FASB, I would say is probably 20 years behind, if not more, in that they still don't believe in anything like a yield curve. They still allow a lot more smoothing, and there's nobody that can make them behave differently because there is no federal regulation of state and local plans.
Ann?
No, that was a great question. I have 2 quick things, one of which will be for Felix. I have a feeling, excuse me, in Vallejo that the policemen and firemen may have taken a discount on their health care benefits, but not on the underlying pension. That's a quibble we could come back to. Yeah. But here's a more important question. I'm going to ask this in the context just of California, which you may not be experts in, but California is a big enough state that it's an interesting thing to look at. Those of us who come from the corporate side are always a little bit perplexed because in corporate bankruptcy, if a situation is unsustainable in terms of a company being able to, honor all of its debts and obligations, there's a resolution for it. And we're told that for states and to some extent for municipalities, there aren't such resolutions, that in particular, pension promises are really non-negotiable and non-discountable, let's say, in any kind of bankruptcy or resolution forum. And I want to give a specific example with regard to California and ask about this. There was a State of the West thing at CEPR a few months ago, and I think Joe Nation came in and said, here is the way that a typical California state employee accrued benefits up until this year. Anybody hired before this year accrued under the following benefit: 2.5% per year at age 55. Now, this meant that every year you were employed, you would accrue a benefit of 2.5% of your final salary that you could take at age 55. So if at age 55, you'd been there for 30 years, 2.5% times 30 is 75%. On the day after your 55th birthday, you could walk out of there with a pension that you start earning the next day of 75% of what you made the last year, and you'd get that every year probably for about 30 years because your life expectancy is probably pushing 85, let's say, between 80 and 85, which is clearly a much better deal than any of us who work in the private sector have. Now, here's the interesting thing. Schwarzenegger, just before he left, renegotiated this. By the way, the deal is better for police and fire. There was 3% at age 50. Now, Schwarzenegger, just before he left in California, negotiated with the unions a deal to change that for any new employee, excuse me, to, I think, 2% at age 60. But my understanding is that it's thought to be a legal requirement that anyone who was here under the old deal must continue to accrue under the old deal. So only people hired in 2011 get the new deal, which means it'll be probably 15 years before it even has a positive effect on the budget in any serious way. So I just have a couple of questions. Do we really think it's the state of the law in California that we couldn't try to change that so that people would start accruing under the new deal, current employees, A? And I guess B, are their COLAs also guaranteed by the state constitution? Because simply being able to make some changes like that around the margin would probably make a significant difference in our budget problems in California, and I think we're a big enough state that anything
This is
we did
clearly
would make a difference.
the reason why the Republicans are so keen on state bankruptcy, right? Is because they reckon that this is by far the best way to eviscerate exactly those kind of deals that were put in place by various unions over the years. So, because, and for the kind of reasons that I was explaining as well, it's actually a lot easier to go in and do and change those formulae in bankruptcy than it is to provide a haircut to bondholders. I also wanted, just very quickly, because you mentioned Vallejo, because I happen to have it in front of me right here, a couple of data points, which Vallejo is an absolutely terrifying example of bankruptcy, and no one in their right mind would ever want to go there. They had 495 full-time equivalent employees in 2003, which went down to 312 in 2010. They cut all of their libraries, their symphony, their museums, everything. It is basically not an operating city. Their non-sworn police headcount dropped by 58%. That's like the dispatchers, stuff like that. The sworn police went down by 42%. The crime prevention team was eliminated. Crime's gone up. Calls to the fire department went up by 30%. Firefighters went down by 42%. Okay, so this is what happens. Their roads are...
But didn't the pensioners actually keep all of their benefits? I think we made all the cuts on the back of current services and current employees, I think.
And they're also in the point of doing things which just make no fiscal sense at all. Like, for instance, the roads are not being repaired to the point at which you can't repair them anymore. You need to just tear them up and completely replace them, which is far more expensive than you need. So I just wanted to mention that about Vallejo, getting a little bit away from the pension thing, just to sort of...
No, all I meant was I think you were implying that the pensions of police and fire people at Vallejo were damaged in the bankruptcy, whereas people in other municipalities are not, and I think that's not Right, I think they might have lost healthcare benefits.
If you're one of the 42% of firefighters who got laid off, I can guarantee you that hurt your pension.
Right, but I think any current retirees and all accrued benefits were completely protected. I think they might have lost retirement health care benefits.
You have to go to the mic.
So I wanted to enter that nether world that Joe talked about in terms of the accounting nightmare and that ecosphere, and I want to extend it and say, so if you're dealing with an investment manager for a public pension fund who sees the tail of risk in the way you described and doesn't recognize it, you can obviously, if you put SEC Commissioner hat on, imagine the creativity of investment products that can be designed to be sold into a pension system. Now, I don't have on the tip of my tongue the percent of equities held by public pension funds, but it's somewhat substantial. And so I wanted you to, if you could, talk about sort of this unvirtuous cycle where pension plans are ripe to be taken advantage of and to permit the public markets to generate perhaps equities and financial instruments that they alone would value one way, but the actual market would value very differently. That's one question.
No, look, it's no accident that many of the largest frauds and problems that have come up in the financial markets over the last 15 years have involved municipal finances, or, Orange County, all right, a whole bunch of other institutions that have gotten into transactions that they didn't fully understand, and where questions can be asked about whether those transactions should have been sold to them as an initial matter. And, much of the logic by which many of these institutions got into it is that you could do a PowerPoint presentation that was entirely consistent with the government accounting rules, and you could have people swear up and down that everything that we're telling you makes sense under your accounting rules. And meanwhile, there are huge arbitrage opportunities for the banks that are packaging and selling this stuff, because what you're saying is pay attention only to the expected rate of return. Don't put a price on the risk. And in that kind of a context, it's very easy for me to misprice the risk in a transaction with you because you don't care about how the risk is priced. All right, you don't get a penalty for it. So basically, I am going to sell you a higher rate of return with a hidden higher level rate of risk, and I'm going to make money on the arb by repackaging the risk. You're going to write me an insurance policy at a below market rate, and I'll make money all day dealing with you.
So that was one question. The second, very quickly, is that states have an awful lot of assets. I mean, the state of California has a humongous portfolio of underutilized assets. And I wonder, because I'm not a pension expert, if anyone's thought about, well, what do the pensioners do with the money that we send them? They actually pay rent or mortgage payments to stay in their homes. And the states have, whether it's through tax in rem or other proceedings, they end up holding either built or to be built housing stock. And I wonder if there's ever been an attempt to move some of those assets that are underutilized, I think about Detroit or elsewhere, underutilized or worse, are blighted.
Move
expenses.
California's pensioners to Detroit. Solve all of your problems in the
You can
state.
buy the airline less in price for cheaper. And just what kind of creativity is there for using these underutilized assets?
Creative solutions. Any comments? Any comments? No.
You gave me a rough figure of 5 times 5 trillion, that type of thing, in real problems. Now, is that based on the fact that there has been a significant cut in the stock market, et cetera, which will hopefully after the recession bounce up and relieve some of that? And is that based on assuming that all of the commitments will be extended as they stand? Or does it assume that the pensions could be cut off tomorrow if the states wanted to, and thus it will be even worse? And the second part of that is, you've given us Vallejo. Given the fact that we've heard bankruptcy isn't going to be a very good thing, it's going to be difficult, long, et cetera, it sounds to me as though the final result is Vallejo for these states, that what will happen in 3 or 4 or 5 years is a significant Vallejo-ish situation. The bondholders are committed to be paid until they go into bankruptcy, so they don't care. It's just a Vallejo to the states. Is this what we're looking forward to?
At a bigger scale, and I think that the federal government just wouldn't stand for it. At that point, you start getting bailouts. Vallejo isn't big enough to get bailed out by California, but California is definitely big enough to get bailed out by the USA. Even that kind of like insane crunch is something which just doesn't happen in this particular country. On the level of anything bigger than Vallejo. I mean that's my opinion. I might be wrong about that. But, you had a good question. What was the first question?
I think the first question had to do with...
the 5 trillion and where it came from. Yeah, it does assume no changes to the current structure, right?
Yes, but it's an underestimate because it just looks at the accrued benefits as they exist today. So what it does is it says, so these estimates basically say, let's assume we could freeze the system as it exists now. What would you have to do to get rid of these accrued benefit obligations? It's called the ABO model. If you actually assume that you're going to be bringing more people into the system and that these people will also have benefits that at whatever level aren't fully funded on a going forward basis, the problem is actually bigger than the numbers that have been generated by Novi Marks and Rao. So their numbers, as a practical matter, are probably baseline. Now, the size of the estimate is, of course, contingent on the date you use for the starting date. If we run these numbers before the market crash, the problem isn't as bad as it is if you use the numbers at the bottom of the crash. If we run the numbers given the values today, again, they're obviously not as bad as they are if you were to use the bottom of the crash. Bottom line, though, no matter which starting point you use, the problem is measured in the trillions of dollars and is very, very large.
Peter.
So just a couple questions aimed at different parts of the panel. Felix, you said something I thought was extremely interesting at the very end of your presentation, talking about whether or not the issue of whether or not the states are facing solvency is separate from whether or not they're going to be facing a severe liquidity crunch or problems of liquidity. I wonder if you could flesh that out a little bit and talk about the kind of private placement model that you're describing for municipal bond offerings and compare it to one of the flashpoints in the financial crisis, which was the freezing up the auction rate security market. So to think about, I mean, a liquidity crisis, generally speaking, is that it's not that liquidity is not available, it's just not available at a price that
well, I mean, in the case of auction rate securities, it just wasn't available.
And that's my question, is do you see it following something similar to the ARS model where it's just not available, where states have this big pile of cash through their ability or inability, depending on your perspective, to raise taxes or whatever else they might do in order to raise money in the debt markets? But the question is it a question that they're just going to be pricing it so high that it becomes too expensive for them, or is it just that no one's going to show up? So that's the first question. Let me just throw out the other one and then sit down. So, Olivia, you touched a little bit on the pension, I can't remember the full name, the pension guarantee corporation, the quasi-governmental corporation that's underfunded itself, that is a pension guarantee system. And a related issue to that, I wonder if you could comment on, is in the law we have this National Conference of Commissioners on Uniform State Laws, where it's a non-governmental institution that they look at these sometimes arcane areas of law and say, here are the differences, here's what we say might be a useful way to think more uniformly about the law, and then state legislatures will adopt or not or tailor, but use that as a baseline. I'm wondering, is there such a thing as, or could there be such a thing as, a kind of a race to the top for pension standards for states? So kind of a national conference of commissioners of uniform pension accounting or something like that, so that when you're looking at pensions, you know what you're getting because there's a kind of baseline. Now, I have just no expertise on this, so I'm completely ignorant of this. So I wonder if you'd talk a little bit about what efforts there are to share best practices about pension accounting. Is it simply a question of GAAP and FASB or accounting standards that happen there? Because it sounds like from both your and Professor Gunfest's description, there's a lot of idiosyncrasy that occurs from state to state. So I wonder if you could talk a little bit more about that. So
You want to go first?
Sure. Yeah, I don't think there's any incentive for that to happen. But to answer your question about liquidity, it's very early days. We lost a significant chunk, I think, of muni bond investors during the crisis who suddenly realized, just like they were invested in auction rate securities and in money market mutual funds and in various other things which they thought had no risk, and suddenly woke up in November 2008 and realized they did have risk, and municipal bonds were very much part of that universe of assets which people liquidated or got much more scared of because they realized there was risk there. So are those people going to go, are they going to be gone forever? Can you attract them back just by offering higher interest rates? Do you lose the very risk-averse people who are now probably buying something much riskier and all hoarding gold right now? Do you, and then have to replace them with a new investor base of Californians and local residents who have a little bit more of a risk appetite? Or is there just going to be a big permanent gap, retail gap in your funding base, which needs to be replaced with institutional money of some description, which I think is actually, if you ask me, these are all very open questions. We don't know the answer to them. We won't know the answer to them for a few years as we see how this plays out. But my gut feeling is that we're going to have to, is that states in general are going to have to diversify their investor bases much more than they have been up until now. And by the way, that means more taxable bonds because, institutional investors in general, and certainly foreign investors, have no interest in the tax-exempt bonds.
Yeah. Certainly by the tax exemption, they are limiting their investment base.
Yeah.
So that's kind of a problem. Go ahead.
So I was just going to respond briefly to the other question, if I might. So I really don't see much going on in the states and the municipalities in terms of setting a more uniform set of criteria regarding assumptions, discount rates, and so forth. I think that the only explanation I've gotten from folks about why there's all this smoothing and so forth, why the accounting is so funny, is that the goal from the beginning in the defined benefit arena, and this goes for private as well as public sector employers, is always to smooth contributions. Managers don't want to have contributions bump up and down by millions or billions of dollars every year. And so if you adopt smoothing accounting techniques, that drives a smoothing annual contribution requirement, and people can kind of make plans. Now, there is an answer to that, of course. If what you want is a steady stream of contributions, what you need to do is immunize your liabilities with your assets. In other words, match your assets with your liabilities, so when the liabilities go up, so do your assets. When they go down, so do your assets. And there is a whole school of finance that knows how to do that. But
how does that deal with the stock market crash? The assets...
Well, basically, you invest
Then you
in
don't
bonds.
have stocks.
You invest in bonds.
Right.
So you think about the pension
you match
as
gratuities, you
stream of benefit payments you must make to all of your retirees every year until they all die. And if you were going to terminate your plan, not that I suggest you should, but if you did, then the best thing to do is have a bunch of laddered bonds in your portfolio, and that would be the story, and you would be free and clear. However, what the state pension folks tell you is, golly, if I only hold bonds, then I don't get any risk premium from holding equities. And so I really, in order to cut down contributions, I need to hold equities, and that's the beginning of the unfunded story. The only thing I would say is that there's a few hardy souls out there. Robert North, being the chief actuary of the city of New York, is a good example, who has agreed to present the data the old-fashioned way with smoothing and so forth, as well as with a mark-to-market set of assets and liabilities. And to my mind, he's the only one that has been able politically to be able to display the data both ways. Now, from a contribution and funding point of view, they still use the old data, but at least from an investor, a participant, a taxpayer point of view, you know what the numbers are should you care to look. To my mind, what we ought to do is have a standard, we can have 2 sets of reports, just so all of us know much more what's going on. Now, if you look at the Moody's of the world, they say, oh, well, we've been looking at these numbers for years and doing our bond ratings. But they take the numbers as given, they don't do any kind of adjustments, and so they're as good or as bad as what the underlying data sources are that provided them. So there is not a gold standard, at least that's been accepted in the field, and I think there should be. And ERISA has moved in the corporate sector to helping us understand our numbers better.
So I wonder if you could help us translate the pension underfunding problem into the regular state budget problem. And thinking now just of California as a convenient example, let's imagine that that you get your actuaries with doing things the way they should. You calculate your underfunding the way they should, and so how much more should the California taxpayers be paying into the pension system to CalPERS and the others each year in order to, first of all, make things right going forward, but also to amortize the current underfunding across whatever period you think is appropriate for that? And what will that do to the California budget? How big a part of the budget deficit is that? And is this just an unmanageable proposition? I'm trying to figure out a bit, because the pension underfunding looks so huge, and yet translating it into ordinary budget numbers is not an obvious calculation.
Do you have those?
We've got, yeah, I've got it. Glad you asked the question, because we've actually got the answer. The Novi Marks and Rao actually did that calculation, and they estimate, let's just take it for California, based on 3 pension plans in California, that California's underfunding is approximately 415% of total state tax revenue. So in other words, if everybody quadrupled the state taxes that they pay in 1 year.
But we wouldn't pay this off in 1 year. I think we're currently amortizing underfunding over 30 years. So what does it amount to?
So we would have to do, the best answer that I can give you is that according to Rao and Novi Marks' calculation, in California, you're underfunded by an amount that's the equivalent of 415% of current state tax revenue, which accounts for 26% of the gross state product. Now, we could take that number and run some calculations and say we could split that loss between taxpayers and pensioners. It would be an additional set of calculations, but that's where you would start. And unless you feel too depressed, let me gladden everybody in this room. In Ohio, the number is 874%, all right, of tax revenue, and it's 47% of the gross state product. The best case in the nation is Vermont, 171% of annual tax revenue and 18% of state product.
I'm still not sure that this is being translated, though, into annual contributions from
it's
the
not.
the taxpayers. Currently, I believe in California that about something on the order of 7% of the state budget is contributions to the pension plan. I don't remember where I got that number. Olivia probably knows it off the top of her head. And I'm wondering, will that go up to, in order to make everything right, if we were just Mr. Responsible and started doing everything right from here on, what would that go up to?
Well, I think, as my colleague here said, doing right is always a question of art. That is, you suggested that the unfunded liability could be amortized over 30 years. There's no particular reason that we should do that. The Pension Protection Act says you should do it over 7 years, right? So depending on how you split that, it's an incidence question. Will people today pay for it? Will we kick the can down the road for the future? In the illustrious state of Pennsylvania, where I live, they were running short of money to contribute for their pension fund, and they decided instead of a 30-year amortization period, they would just pick a 40-year period, thereby reducing their required contributions and increasing the funding problem.
But to a first approximation, I think you can take that 415% and divide it by however many years you want to amortize it by.
Right.
So there's your answer.
But then that makes less and less certain the future receipt of people's
If I
pensions
do the
that
quick
may not get it.
calculation, that's then about 13% on top of 7. So our budget, if we started acting, I mean, that's on a 30-year.
This is percentage of state revenues. Right, so the state revenues would need to go up by about 13% from where they are now, if you did it over 30 years.
No, that's what and that's assuming, I mean, there need to be another calculation. We are now talking, though, to do this right at this pension level makes balancing the budget in California,
Impossible.
unfathomably difficult, right?
Well, so I'd like to throw this one comment in as on the tail end of your comment, which is that we have to keep in mind that the tax base itself is endogenous. That is, if it turns out that Illinois needs to raise taxes double or triple in order to be able to pay its pensioners, then people can move. You can live across the border and work in Illinois. You can live somewhere else. California is a big state. I don't expect mass outflows, but quite frankly, if the taxes did go up as we've just calculated, the appeal of California as a place to live would somewhat diminish. And so we have to take into account behavior. Furthermore, if taxes go up enough to also fund Social Security and Medicare, we can't necessarily all leave the U.S., but we can stop working, we can reduce our effort, we can do many other things with our time. So I think as an economist, we have to recall that our tax base is endogenous, and we can't necessarily guarantee paying all these ultimate promises.
The question for Felix. So I'm quite in agreement with your critique of the way people often interpret credit default swaps and bond yields and so forth. But I just want to push you further and try to figure out what you are saying about this. I mean, I guess your claim is that the increase in bond yields for California and Illinois don't really reflect underlying increased credit risk. Right. That in fact people are kind of scared off by things that they don't understand, and so this is sort of an irrational gap of the kind. So because ultimately you agree with Buffett.
I think what I would say is that they were being irrational when they thought that it was all entirely risk-free and there was no market risk and so on and so forth. And that now they're probably being more rational.
So, but ultimately, I thought I kind of perceived that your larger point was that really the California and Illinois are implicitly guaranteed, and that's a pretty strong.
Yeah, I don't think you're going to see a sort of substantial long-term payment default on the bonded geo debt of California.
You're talking about market risk down to credit risk.
Exactly.
So California state bond, general obligation bonds are a really good deal.
Good deal, yeah.
Well, I mean, does anyone know what the yield is on California geo bonds right now? Because remember, these things are tax exempt, so their actual yield is not that attractive. You need to be a California state taxpayer to even begin to find them attractive. And then what that does is it massively narrows the potential investor base, because what you want is, institutions and global investors all like taking a look at this particular asset class, and they're not right now.
This all leads to kind of interesting empirical proposition. We'll have to wait and see. But your suggestion seems to be that it's really large states who have the strongest implicit guarantee, and that New Hampshire maybe is in a different boat.
Absolutely. The moral hazard trade is definitely on in California. I would play that trade every day until Armageddon. But you're absolutely right.
So would you guess that would affect bond yields then?
That's going to keep yields
state
down.
size in there, and you would expect it.
Yeah, the moral hazard trade, especially in California, is going to keep yields a little bit lower because there's definitely a sort of Obama put. There's no way that Barack Obama is going to let.
Obama put.
Yeah, it's going to let California default.
Yeah, the question is what, I think I probably agree with you on California, but then where is that
Yeah,
line?
exactly. And then, if you're dealing with Vermont, maybe not so much.
Doing a little better.
Speaking of Armageddon, the picture is very sobering. I think there is history that when things have looked as bleak as you say, that an increase in the economy has changed the picture very dramatically, faster than anybody thought. I'm personally not terribly optimistic about the economy right now, but it doesn't have to be quite as bad as the picture that's being painted if revenues go up, if business increases, et cetera. If it doesn't, and if several states or a group of states get into the situation that California seems to be heading for, where, as somebody was saying, the unfunded liability just for pensions is 4 times the state's revenue, and there's a point at which the can is flat and it won't get kicked down the road. Yeah. Well, when that comes due, and when there is a financial crisis that is no longer fundable, it appears that the legal foundation for that is that the people who have already retired, as in Vallejo, those are the folks you can't touch, and that's the liability that you can't touch legally. So you can deal with everything else, like future liabilities and current employees, but you can't touch the elephant in the corner of the room that's filling most of the room. And I'm wondering if much of the nation is heading down that path, you really only have that problem for probably the last 20 or 25 years. Before that, public pensions were nowhere near this generous, and you didn't have this kind of problem. Public pensions were safer, but no bigger than corporate pensions at that time. And currently, many states are changing pension plans and benefits, as you've discussed quite articulately, in a lot of ways. What you've got is, I don't know, a 15 or 25-year group of people who are going to get pensions out of all proportion to either prior folks, prior workers, or future retirees. And the question will be, do you want the police officer who not only is getting 110% of his or her pension, but it was also based on not only their base salary, it was also based on their overtime, which they ginned up the last year. So you've got a police officer who's going to get $125,000 a year, and you have, certainly that's the extreme. Many public employees aren't doing anything like that. But in a sense of equity, if the legal foundation changed because the problem was national and serious enough, would there be any basis for allowing some adjustments to pensions that had been guaranteed for retirees who have already retired?
I mean, I can't remember where I saw it, and I'm pretty sure it was Vallejo, that the average retiree in Vallejo was getting somewhere between $20,000 and $30,000 a year in pension retirement. These are not, gold-plated Cadillac retirement plans at all. So, I mean, point taken that, that there is this kind of group of people who have negotiated this, but at the same time, this was negotiated, with politicians. We've talked about the incentives of the politicians with term limits and so forth. More or less in lieu of the pay rises that were being seen in the private sector at the time. So, they're like, okay, these guys are getting big pay rises in the private sector. You're not offering me that because you don't want to raise taxes, so give me a more generous pension instead. And so then to turn around sort of 20 years later and say, oh yeah, that pay rise that we gave you in the form of a higher pension, you can't get that. That seems a little bit,
But the fact that the pensions aren't funded means they did not substitute pensions for wages. In other words, they got the wages and the pension promise, and that no money was set aside to fund them. So I think, what you're saying has to be caveated a bit.
Also, the Vallejo situation, the statistic you're talking about, Felix, has been widely circulated and written about, but it's a bit of a misnomer, and I don't want to take a position against fulfilling obligations or against public pensions. That's not my point. But many people come to a public job midway in career. So they may be vested at 5 years or 10 years and then retire. And that brings the average down. Other people come to the job early but then retire, go on to something else. So they've worked 12 years, but because they vested at 10, their $11,000 a year pension brings down the average from the person who is making 6 figures on pension. So that average figure is not a reflection of people who have spent their career in Vallejo.
Let me just pick up on one point that you shared and point out how it actually suggests that the projections are worse than anybody's talked about, because when you do the Monte Carlo simulations out in the future, what it assumes is that if you have certain states of nature that are very positive, the market performs well and the underfunding declines, that money will actually stay in the fund, and then you can have another good realization, that money stays in the fund. But we know politically that if you have these good realizations, what happens is you just negotiate more benefits. So what we see is that there's another endogeneity in the assumption which isn't built into these models, where in the best cases, what you'll then have if the political system in the future operates as it has in the past, an increase in the potential promises that you're making to the
Decreasing
retirees.
contributions. They canceled the contributions of
Right.
when times were good. So that's
Right.
kind of a
Exactly right. When
ends up
times that they
happening.
can't, so we have proof that this is actually what happens. And when times are bad, it's much harder to cut. So you have another
distortion.
bias in the system, institutional bias, where, again, these projections, I think, are overly optimistic because it assumes that if you have a good realization in a Monte Carlo simulation, you get to keep it. Politics, the history of politics in this area says, no, you don't.
Perhaps we could take the underfunding by some kind of statute out of legislative salaries. That might solve something.
We have time for only one question, barely. So.
I'll be quick. It was 34 years ago, Professor Halpern in this building said this is the Alaska pipeline professor, he thought lawyers were crooks, but then he found out about accountants. So,
why are you looking at me?
Because you referred to accounting. It seems that the political dynamics are obviously going to change in the future. You're quite right. The up and down. California's income is heavily reliant on state income tax, capital gains tax of wealthy people. In good times, we spend it all, and in bad times, we borrow. We're waiting for good times to come back. Right. Unfortunately, the borrowing never gets paid back. Given this dynamic, is it feasible to get more of a social contract system that just allows for the political dynamic to continue, fight for benefits, pay the benefits? More of a 10 or 15% of the government entity budget will be for pensions. It'll be paid every year, because ultimately everything is paid every year and collected every year. And then that is done on a prorated basis for the people who have the benefits according to the ratio of which they've been able to negotiate. Now, and the question is, to what extent then, to titrate that, can you decrease benefits in the back door with techniques like federal tax rate for pensions, the change in the definition of the inflation rate, the denial of other benefits such as Medicare medical supplements for people who have pensions above X amount. There's a very large number of things that could achieve the same result of reducing pensions through the legislative process that will be legal. There's at least 7 or 8 different ways that can be done. And that is what will happen most likely if we do nothing. But the general comment is, can there be some kind of more of a social contract? Pensions are important. 10% of revenue should go to pensions. You guys decide how you divide it up.
Oh, can I come, my own favorite legislative solution to this particular problem, it's not a complete solution, but a very large increase in immigration would solve a lot of these problems.
As long as it's targeted. Well, I would just add, in response to your question, that some countries have actually developed what you're calling the social contract, or a pre-commitment, ex ante, before bad times hit. So, for example, Sweden has put in place in its pension scheme something called longevity indexing. We know longevity is going to increase in the future, and so what they do is at retirement, they say, here's how long we think your generation's going to live, and index the benefits to that at that point, so that everybody shares in the longevity enhancement. In Japan and the Netherlands, they've both put in place ex ante. In Japan, they call it a macroeconomic slide, which is sort of a long term. But basically, the notion is if the revenue coming in is insufficient to pay promised benefits get cut. And benefits for people in retirement status have gotten cut. Similarly, in the Netherlands, they have a prefabricated social contract agreement deciding how they're going to deal with the problem that funding has gone down. Now, this all looked great, and I was very much in favor of it, 5 years ago. The proof now is going to be in the pudding. Are they going to be able to put in effect what they promised to do when everything looked rosy? Japan has had to do it. It's going to get worse, for sure. Netherlands is kind of gnashing its teeth, saying, well, maybe not this year, maybe next year. Same with Sweden. But the idea is, I think, a very sensible one. The problem is, how can you bind future politicians and taxpayers and the unborn to agreements we make today? And it's almost impossible.
I think we're going to, Peter, you have wine in this reception later? We're going to need to drink heavily. Yeah, I know.
Closing remarks.
Thank you very much, everybody.
Well, I'm going to get started quickly so I can get ended quickly so we can get to the wine quickly, unless there are any objections. I've been asked to give concluding remarks, which typically involve some summarizing. I have to say I have heard so much today. Each of the panels was extraordinarily substantive. I have about 8 or 9 very closely penned pages of notes. I'm reminded of the Monty Python routine, I'm now showing my age, from a few years ago. Do you remember the Proust summarizing contest? This is a skit in which people come in and summarize the entirety of remembrance of things past in 2 minutes. The best contestant that I remember was the volunteer fire department from an unpronounceable town in Wales that did a barbershop quartet version of Proust, which began by saying, "In remembrance of things past, Proust said," and that's all he was able to get. They were able to get to by the end of the 2 minutes. I feel a little bit like that. Do you remember David Skeel this morning? He got us started off after a brief reference to or actually about 3 or 4 very witty references to the Navy SEALs Team 6. He presented what I think still amounts to the only real proposal for a solution to these problems of the day, namely extending federal bankruptcy laws to the states. He told us various reasons why this might be a good thing. Answered several and anticipated several objections to the scheme, and then went off to his alumni event. Almost immediately, we began hearing reasons why this is not such a good idea. The main ones are based on the idea that it's just simply a misdiagnosis of our problem. That fundamentally the problem is that states have been assigned counter-cyclical responsibilities like Medicaid and unemployment, and their revenues are also profoundly affected by the cycles of the economy. And if this is so, if these are their responsibilities and these are their revenues, well, we should not be surprised that in bad times the states are going to have enormous deficit problems, and they can't even according to their own balanced budget requirements, borrow against them. And this looks like a terrible mismatch of responsibilities and powers on the part of the state. We next heard, though, that this may be, that's an underestimate of the problem, that the problem is even more severe than that because it isn't really just a cyclical problem. We are in a long-term secular trend in which wealth generation is slower than it has been, and the demographic time bomb is more severe. We are trying to provide for benefits for larger and larger numbers of older and older people based upon less and less economic growth. That's not going to look very good, even if the economy does bounce back eventually. And then maybe it's really bad for more philosophical reasons, which are essentially political flaws, that politicians in a democratic society serve relatively short terms compared to the effects of their policies. Of course, they're going to be short-sighted. They want to make lavish promises today and leave it to some other time to pick up on those. And my goodness, Plato knew about that, and we haven't yet worked out a solution. David Skeel's solution looks better and better. At least he has a suggestion. But the problem is that bankruptcy can't do anything about any of those problems that we've identified. And somebody put it, I think it was Marcus Cole put it, that we are looking at legal and financial solutions to what is a political problem. Now, personally, I'm not quite sure that that's so. It does seem to me that there might be some very modest purposes to state bankruptcy that are not going to solve most of the problem, but might help with some legal aspects, some of the problems that are legally baked into the cake. For example, state law commitments that we continue to fund pensions in the future for future accruals at lavish promises of the past. For example, state provisions that don't allow any haircuts to the bondholders because of full faith and credit provisions in state constitutions. Perhaps, no one's talked about it, perhaps some state constitutional limitations on taxation that make it very difficult to have a modern, well-balanced tax system. Prop 8 might be an example of that, or states that might have state constitutional limitations having to do with where revenues go that might be profoundly irrational and counterproductive. This sort of thing might well be eliminatable, if that's a verb, in federal bankruptcy because of the fact that federal law preempts state law, and in a bankruptcy proceeding, maybe that's what this would be used for. Then we moved into larger discussions of the problem. We had a fascinating debate between Joe and Olivia. Joe took the position that things were actually worse than what she said. If I understood her argument correctly, she says that they're actually worse than what he said. I'm not sure who won that particular debate. It makes me think that maybe David Skeel did, in fact, get it right the first time. The only solution is send in the Navy SEALs Team 6. Thank you for attending the conference.